Hello, Dave Boucher here. What I'm going to talk about in this demonstration is operating income valuations and hedging. What you see here is an income statement based off, here's the actual performances, and then you got the budgeted, and then you got projected for 11 years, and the terminal value for the 12th year, because we were interested in a long-term 12-year value, what our cash position and our loans and so on and so forth is going to be for that 12th year. Now again, a lot of these numbers and dates of values have been changed due to demonstration purposes. But to get an idea, we created this income statement, have income statement assumptions to create the actual income statement values based off of net service revenue. So basically the gross profit margin and all the margins for each office have relatively the same values based off of that net service revenue growth between the first 2 years. Now the numbers that I want to point out to you that are important is management performance ratios based off of those growth numbers. The highest two that we wanted to point out is the CapEx as a percentage of EBITDA ends up being 20% growth for the next 11 years, and then also too the gross margin itself is almost 20%. So that's a generic number which is relatively okay. Now we also built common size statements as a percent of revenue. So you see here the EBITDA is 15% because it's based off the growth rate change. As you see, 15.9 and 16.5 on the first two change, but as a percentage of growth revenue, we put it at 15 all the way throughout. And then you do the same thing for the balance sheet, and you do the same thing with the balance sheet assumptions based off of the net service revenue. And then a couple things here is the payables are the higher percentage of net service revenue, with the billings being a lower as 2%. And you do the same thing with the cash flow, and even do a reconciliation of cash flows to put the numbers in line. Now, as far as the whole point of this is, you also want to find the discounted cash flow, because you're trying to find the estimated fair value of that terminal value, because you're looking at this last year here is what you're really interested in. So what you do is you get those cash flows available to equity shareholders throughout the year, and you see that they're growing out the year all up to a number of 168,364. And you put that number over here, 168,364, to find your actual terminal value calculation. So then you also need to get your annual cash growth, and then your discount period, which is the whole 12-month period for a number of 13 years. So you get the present value factor, which is the important number right here of 3%. You take that present value factor, you put it over here, present value factor, because you're trying to find this terminal year value. So your cash flow is that, and then you get the rate minus the growth, which is 13%, and you get your terminal year value is 1.247. So then after you take out the discounting periods multiply it with the percentage present value factor, you get the present value of your terminal year as 45,940, and your terminal value plus the present value of internal cash flows ends up being 110,652. Take out your discounts and your interest on prorated basis, and your estimated fair value then winds up being 21,920. So that is the base value of that 12th year. That's what your terminal estimated fair value is going to be. Now, other ways of looking at the data for companies and comparing projected values, either linear trends or revenue trends, like I showed you, is there's several things based off of ratio analysis. Obviously, just like we just did, you put together your balance sheet. Now these are actual though; these aren't projected. So first, I just want to do a 5-year actual estimation. So you have your balance sheet, your income statement, and your cash flows, and then from those numbers, we can analyze, based off those 5 years, we can analyze some trends. So to start out with, we want to look at what the EBITDA margin looks like. So the EBITDA margin ends up being relatively the same throughout the 5 years, and your cash flow ends up growing though. Now the working capital is going a lot less, so it's been going consistently a couple hundred less each year, and your liquidity has gone down too. Now, your return, your required return is 11%, but your multiplier is 3.14. So what does that mean based on value? Well, the value ends up being at a nominal growth rate of 3.5, 78.605. That's your value based off the earnings. So what kind of operating leverage does it have? Well, the operating leverage ends up going down each year. So it's not too bad going down, but it is definite caution because it is going down. And then the financial leverage is also has been decreasing. So you look at it from a ratio standpoint, your ratios have been going from the current ratio. It's been consistent. It's gone down a little bit, but it's mostly been consistent, which is okay. And the liquidity has also been very consistent. But one thing is your z-score. Your z-score is very, very high, and then it's getting down to low, which is better. You want a 1 to a 3 type of score, so your z-scores have been improving. And your receivables have been not the same to getting a little bit lower. It's been going down. Your margins have been the same throughout, but your debt to equity has decreased. So your debt has gotten less, which is good, and your price to earnings and your price to book value though has gone down. So that's a little bit hesitant. But your stock yield has gone up, but not considerably. As you can see, it's gone slightly up. So let's put this in a graphical standpoint. When you to make a comparison to the industry. So when you look at it comparison to the industry, you see that the receivable turnover, so that's the one I want to talked about a second ago, is gone down. It's been going down, getting closer to the industry, but it's decreased compared to the industries. It's relatively stay the same. So we want to try to get this more to be consistent, even though it is higher than the industry. Another one thing I want to talk about, an interesting graph, is this gross profit margin. It's been consistent with the industry, and it's almost exactly the same for the most part, which is interesting, because your ROA, we have been decreasing the past couple of years compared to the industry is going up. So our assets, there's a little bit of caution in that. Now, the debt to equity though, debt to equity has gone down, as has industry, but it's been so much higher percentage compared to the industry. And finally, the sales to worth comparison. Sales to worth is way higher, and it's been a lot higher in a ratio compared to industry. So that's a decent position, and the trading ratio has also been a lot higher. Now, the other thing I want to talk about is the horizontal analysis. On the to do a trend, looking at trends, this is a little bit different than looking at it from the other graphical standpoint, in that you can see that the growth in net sales has dropped down considerably, and as you're getting up to 2010, and your growth profits, it's gone up and down a little bit, but past 3 years has gone down also. Same as your earnings per share, that's been dropping considerably. Now the other thing, it's a little funny, is the SGR. Your sustainable growth rate has relatively been consistent the same, even though all those other trends have gone up and down differently. But your sustainable growth rate has been the same, but your growth in market capitalization has gone down a lot. And that's not too good, because it's not good, because it's gone down, dropped so much dramatically, and it's been consistently dropping. Now to look at the pro forma, let's say you want to look at, instead of historical, say you want to do a few more years down the road. What I'm bringing in here is a trend. I've already showed you a basic projected in revenue. Well, this is a trending. What do the revenues trend look like? Well, what we do is use the X as the year, and then the Y as the total revenue, and put those numbers together. You get that. But what I want to show is this R square. The R square ends up being a 0.98 or 98%. So as you can see, the trend, that's basically using the slope factor. It's been consistently, has a good sign on that. So then you can build your pro forma income statement and your cash flow and so on. Now, to look at the scenario, see what the difference between the two methods are, is to sum up, you can see that the simple projection method that I've shown you, it has a 48, and then the linear trend is 47. So all these are relatively close. Both methods are relatively close. Even the extraordinary items, which is the smallest value, is a lot higher than the here, but it's still pretty close with the total net income being only 1,000 off. So they're both decent scenarios. Now, finally, the budget analysis, just to compare what we did historically to today's budget compared to each year, you can see that in the income statement, the net income has been increasing. So that's good because we've been getting closer to it in the middle, but our net income has grown a lot compared to what we actually budgeted, which is always good. And then in the ratio area, your total asset turnover, we've been off on that. So our turnover has been negative values. And same with our net profit margin. So our net profit margin was down considerably what we budgeted, but it's getting better as the years move on. And ROI has increased a lot. We were really bad on budgeting. ROE, I should say, return on equity. But our ROE, we've been outshooting the ROE value by 16% in this last year. So that takes care of that kind of analysis. Another topic I get a lot is the hedging. Clients want to know the risk or don't understand hedging or are afraid of hedging. Well, I just want to run through a basic spreadsheet I put together. You thousands of different software and numbers that you can use to build its own hedges, but just to show clients, a lot of times what we do is show, okay, here's a stock position. So say you have 942 as a price of a stock. You get 100 units of it. It ends up being $100 million. So you end selling it 990, 106. That's 104. We end up having a return then of 6011936. That ends up being a 6% return. Now, if you do it with a future contract speculated at 934. So that's your 100,000 units that you put in on a contract. And then if you sell it at that 990 at that same time period, it ends up being a difference of 55, which ends up being 5929. So that has a return of 60121 with 6.12. That obviously is higher than the 611. So what does all that mean? Well, all that is that the price difference, comparing the S&P, the regular stock price numbers compared to what our hedge position. So our stocks that we sold for was 942, and then the futures that we speculated at was the 934. So we settled the futures of 827 as the difference between the two. So that's that 884 based off the 428 number of units. That's the 884 difference as a value. After you take some of the, you add the dividends and take the interest out, you end up a total being 100,100,100,903. So you have a return of the difference between the two of 112 hedge position, which is a extra money in your pocket you wouldn't have if you just did stocks. So your hedge position ends up being 112,053 if you had done the hedging value. All right, that's the end of this session. Thanks for your attention.